Even if the stock market is currently sitting close from its all-time high, there are still plenty of great opportunities that can be found. It is why in this video, you will discover 3 of the best stocks that you can buy right now in September 2024. So, without further ado, let's take a look at the first pick on my list. The first business that I've included on this list is the company Alimentation Couche-Tard with the ticker ATD. This convenience store brand that is worth over $50 billion is currently in the midst of an important acquisition process. Indeed, a few weeks ago, they've announced their intention to buy and purchase the largest convenience store brand in the world by number of stores, 7-Eleven. While Couche-Tard remains the second largest convenience store brand in the entire world with their numerous subsidiaries such as Circle K and Ingo, an acquisition of this company would be huge for Couche-Tard. However, knowing that the Japanese company 7-Eleven is currently worth about $50 billion and that Couche-Tard only has about $1 billion of cash, this might be a quite complicated transaction to be made and it might require to be financed a lot by debt. In total, the deal that was proposed by Couche-Tard was a non-binding proposal to 7-Eleven to purchase them for about $38 billion. On their side, Couche-Tard has also recently confirmed that they were reaching out to different funds such as the Caisse de dépôt et placement du Québec, Canada Pension Plan Investment Board, and Ontario's Teacher Pension Plan to gauge their interest in providing financing for this big acquisition. So in total, it means that this company will need to raise billions of dollars from different investors to be able to make this purchase. Despite being considered as a friendly, non-binding offer, 7-Eleven is currently looking for great ways to protect themselves against this acquisition, which means that their proposition might be pretty serious. And so with over 83,000 locations of 7-Eleven located all around the world and most precisely in Asia, combined with the 16,000 Couche-Tard stores, if this transaction was to be made on, it would create a massive mastodon. Unfortunately, one of the biggest risks that often occur from merging and new acquisitions is the risk of potential overbidding on an acquisition, which could come dilute the total assets of the current shareholders of Couche-Tard. Plus, in the short term, as we can see with Couche-Tard, this type of news has the impact to lower the total value of the company. This comes from the fact that many acquisitions such as the big 7-Eleven acquisition offer will need to be financed with a lot more debt, and obviously many investors are not seeing that with a good eye. Nevertheless, knowing that Couche-Tard is a company extremely well managed that is aligned with the future by having different measures such as installing great electric vehicle chargers in most of their different locations, they are able to keep a great competitive advantage in their field that help them year after year to continuously grow. Plus, with a pretty low price to earnings ratio of 20 and great growing revenue over the last couple of years, this is definitely a company that I am keeping on my watch list. Add to this, a few years ago when we've seen that Couche-Tard tried to acquire Carrefour and that its stock price dropped, well, I've decided to purchase a certain number of shares of it, and in less than 3 years I've been able to make over 100% of unrealized profit on it. And so personally, I see these news as a win-win situation for the different investors. On one side, if the acquisition has to be made, obviously it will create more debt for the company, but it will also give them a lot more potential for growth. And on the other hand, if the transaction is not allowed, it won't stop the growth of this type of company in the long term. But now that I've talked a lot about this first stock that was on my list, let's examine what is the second stock in it, which is the company Tesla with the ticker TSLA. Over the last couple of years, Tesla has been a fan favorite, notably for its extravagant CEO Elon Musk, but also for its different revolutionary products. Indeed, this company that is currently worth over $500 billion is mainly known for their great electric vehicles, but they are also producing different energy products such as solar panels and their famous Powerwall, as well as different charging equipment for their cars. Add to this, recently, the company has started to work on different robotics projects such as their Tesla bot that is able to replace a human by doing relatively unsafe, repetitive, and boring tasks. However, while the market has boomed over the last couple of months and years, Tesla has been one of the few big tech companies that hasn't been able to grow as much as its competitors over the last couple of months. This is mainly due to the fact that our more recent earnings reports have been truly shaking the value of this massive EV giant. For example, in their more recent earnings report, we see a certain decrease of their total production and deliveries of new cars year over year. This is due to the growing competition in the EV market, where we can see that in the second quarter of 2024, Tesla was down to 49.7% of EV market share in America compared to owning 75% of this market in the first quarter of 2022. Nevertheless, despite having more competition in the market, Tesla remains the largest and the most important competitor in it. One more worrying point for the investors is the profitability drop that Tesla has seen over the last couple of quarters. In the past, we've been used to see great profit margins coming up of this company before that they've decided to cut the price of their cars. Indeed, in 2023, we've seen that the company has decided to cut the price of multiple of their cars to fight back the lowered sale that they've been experiencing. The problem is that when you combine that with surging expenses, as we've seen in their latest earnings report, this creates a lot less profitability for the company. This is why in their latest earnings, we've seen that their operating margin have been shrink by 333 basis points year over year, down to 6.3%. At the end of the day, even if Tesla has lost some ground over the last couple of months and years, I personally believe that it remains the leader and one of the best options for you if you're looking to invest directly in some of the best electric vehicle companies, especially when we know that the EV market is expected to continue to grow at an average speed of about 7% per year for the next 5 years. So if the company is at least able to lower their total expenses, and if they are able to continue to increase their total revenue quarter after quarter, I personally believe that they'll be able to reach some great financial results in the next couple of quarters and years, since they don't have a lot of debt to their name. And so while the market has been firing up over the last couple of months and years, this stock is pretty interesting at the moment in my opinion, especially since it is down more than 15% since 1 year. Finally, the third and last pick on my list is Chevron with the ticker CVX. This energy company that currently ranks amongst the 5 largest oil companies in the entire world with a market cap exceeding $200 billion has been on a certain downtrend over the last couple of weeks. One of the reasons that explain this switch of momentum is from the clash that they are having with ExxonMobil from the acquisition of Guyana asset. At the end of 2023, Chevron has been saying their intention to purchase all of the outstanding shares of Hess for a transaction estimated to $53 billion. This type of acquisition would have given a super valuable asset to Chevron in the form of the Stabroek block in Guyana, which is actually the world's largest oil discovery in almost 2 decades. And so this combination would have brought together 2 strong companies that would have created one premier integrated energy company. However, over the last couple of weeks, we've seen that one other giant energy companies in the US, ExxonMobil, has been trying to break this transaction by stating that Hess should have first given it the opportunity to purchase its stake in the Guyana asset. It now shows that the 2 giants are in an arbitration battle. Inevitably, this case will be solved in months, if not years, which isn't some great news for the different Chevron investors. At the same time, we can see that our more recent earnings report hasn't been the best. Indeed, in the Q2 of 2024, we've seen an important decrease of their total earnings per share and a certain decrease as well in their total free cash flow. The earnings diminution on its side was justified by the company due to lower margins on the refined product sales, and on its side, the lower free cash flow were justified as being some higher investment in the capex, notably due to higher investments in upstream. At the end of the day, Chevron is slightly down of about 5% since 1 year, which is showing that the company remains pretty stable and pretty solid. Add to this, it is offering a great 4% quarterly dividends to their shareholders that is financed with a fairly healthy payout ratio and with an excellent price to earnings ratio of only 14 at the moment. It is showing that it is also another stock to keep on your watch list. So there you have it. Those were 3 interesting stocks that you might need to keep an eye on for the rest of 2024. However, on your side, if you're looking to find other great Canadian stocks that are currently in discount and that are offering great potential of upside with great dividend income, well, check out the video that's gonna be right over here, and I will see you soon. Peace.